Hi, everybody. Welcome to Friday Live. This is Friday, January 20th, 2023. And this is HBK Provident Advisors, 15, 20 minutes every Friday, 12:30 p.m. Eastern Standard Time. Talk a little bit about financial planning, to talk about the markets, give you some general ideas and observations. And they are general ideas and observations. Keep in mind, these are not specific recommendations, but rather some anecdotal, informational, factual, some things that we might think might be going on into the future. So you really do need to work with a qualified financial professional, qualified tax professional, and or qualified legal professional for specific recommendations and actions on your account. General observations here. I'm Brian Peluso, one of the partners at HBK Provident Advisors, certified financial planner, chartered life underwriter, credit and investment fiduciary. I also have another one of the partners of the firm, Mike Kutch. He's here with us every week. He is the most consistent of the attendees of Friday Live to talk about what's going on in the market. And we're going to start out today with one of the other financial planners on our firm, Laura Wider. Laura Wider is going to talk to us a little bit about balance in your life. Obviously, part of your life is your financial life. How do you balance that? The different components of your financial life, and that flowing over into your life as well. I am going to conclude by addressing something that I hear on a regular basis. Brian, the market was down last year. I don't have time to recover. I'm old. I'll never recover. I'm going to address that very specifically with some factual data, historical data, to help folks that feel that way to interpret whether that's actually the case or not. So thanks again for joining us. If you hear anything that is something you like, that's applicable, do give us a like there on Facebook. If you have any comments, throw in a comment to us as well. So Laura, talk to us a little bit about balance.
Yeah, of course. Thanks, Brian. And balance is so important for so many different reasons, whether you're still on your New Year's resolution kick for a diet, an exercise program, or if you're trying to get your finances in order. So Allie and I were actually talking this morning, and the least expensive Super Bowl ticket right now is $6,000 for the least expensive one ticket for this year's Super Bowl. Can you guys think of anything else that's $6,000 for like last year?
Well, let me see. That could be a weekly Amazon bill in my household. But I'm kind of thinking it's probably the IRA contributions you're referencing.
It was the amount for 2022's traditional and Roth IRA contributions. So instead of going to the Super Bowl, you could watch it on TV, have front row seats in your jams, and fully participate and fund your Roth IRA. So take that into consideration. But I did want to talk about some balance as well. This is like the January is like National Balanced Month or something like that. So in finances, people are always curious on what to do with their money. First, you got to make a budget, but then after that, it's kind of like, where does your money go? You can really use that on a 50-30-20 rule. So 50% of your income should be going towards necessities, bills, utilities, food, anything like that. 30% should be for fun money, anything discretionary, nothing that you actually need to live. And the remaining 20% should be savings. Now, we would suggest that 10 to 15% should be going into your retirement plan. You don't just have to do what your employer matches. You can do more than the match. Anywhere from 10 to 15% is a good rate. And then the other 5 to 10% can go to building an emergency fund. And just to recap, we say it almost every week, have about 3 to 6 months of monthly expenses saved in cash. So that can go towards building that. And then I also found something interesting this morning as I was on Investopedia. By the time you are 30 years old, you should have at least your salary saved for retirement. And then I have a couple other for the decades. By age 40, you should have 3 times your salary. 50 is 6 times. 60 is 8 times. And by age 67, it should be 10 times your salary. So for an example, if you make $75,000 a year, that'd be about $750,000 saved in just your retirement accounts. And with that being said, you should be planning for about 60 to 80% of spending in your retirement years, like what you're spending now. Because a lot of people think like, oh, my mortgage will be paid off. I won't have any bills. Like I'll get the 65 and older specials at the local restaurant. But you're still spending a lot, spending time with grandkids, traveling a lot more and stuff like that. So definitely bump up those retirement account contributions. And, with a lot of industries and a lot of employers, they don't offer pensions anymore. So saving for your own retirement is huge. It's super duper important. You do not want to rely on Social Security. It is just such a small part of your monthly expenses. So please log into your retirement account and take a look at that for review.
Yeah, and there's so much of what you had mentioned there, Laura, that flows into other parts of your life, right? And if we got so many aspects of our lives, we got our personal relationships, we got our finances, we got our work life, we've got recreation and all of those things, and as we all know, but we should recognize if any of those components are out of balance, it really affects everything else.
Causes a lot of stress.
It absolutely does. And hey, let's go to the extreme here. What's the number one cause of divorce? It's finances. So if your finances are, just using that example, if your finances are out of balance, that affects your personal relationships. Ultimately, it begins to affect your health because stress is like concern.
Yeah, stress is like the number one cause in like heart attacks, heart disease, all these.
Absolutely. Absolutely. So it becomes a domino effect. And that's where we step in, is on the financial side. Let's get you balanced. Let's get you comfortable. Let's get you confident with that. The markets go up and down. And Mike's going to talk about that a little bit. Hey, last year we didn't feel balanced, right? Market's down a little bit. We got crazy news that really does affect the markets. But through the financial plan and some of the things, the percentages that Laura had talked about, you have that plan that makes sense in your life for your goals in your situation. Market goes down. That doesn't mean you're out of balance. That means the market went down. That's still, you still, and many of our clients still are on the path to great financial success. But yes, Laura, you're right. That balance in each components of your life. And that's where we come in on the financial side and say, hey, let's make sure all of those pieces and give you that confidence, so that confidence and that balance in your financial life flows into your personal life. It flows into your recreation, it flows into your professional life. Have all those balances. Mike.
Most couples about to retire want a comfortable retirement. So they want to live comfortably and not have to worry about, penny pinching or, whatever. So
I agree. Mike, is the market balanced? Let's narrow it down. The financial planning that we do covers a lot of different areas. It's cash flow, it's retirement income planning, tax minimization ideas, insurance planning, protection planning, estate planning, obviously the investment planning. We try to balance. So let's narrow it down to the investment side, which Mike really specializes on for us. Is the market balanced, Mike? How's the balance in your world? Mike said he might be going doing a little bit surfing down there in Florida later this afternoon. That helps him in his balance. So, Mike, talk to us a little bit about the market.
Yeah, I don't know whether you can really say the market's balanced or not. Your allocation could be balanced among different asset classes, but I'll talk a little bit about what's going on right now this week, what I'm seeing. So earlier in the week, the S&P retested that downtrend line that has been in place for the last about 12 months now. So that's the fourth time over that time period where we've come up to that, we've rallied up to that and failed to break above it and then reject it and moved lower. So on Wednesday, we got a brief relief from lower than expected producer price index, which is a signal for inflation. However, the focus quickly shifted to the decline we saw in retail sales. So it appears to me that investors are starting to place more emphasis on the risk of a recession versus the benefit of decelerating inflation. So what that means for investors is bad economic news may actually be viewed as bad news for stocks. Something we really haven't seen over the past 6 months. We've been in an environment where bad news is good news for stocks because of what it means for the Fed and what they'll do. So to kind of summarize the economic picture, we're seeing a slowdown most notably in housing and manufacturing. Now it appears to be seeping into consumer spending, at least on the good side. Spending on services still seems a little more resilient. People are still eating out. They're still traveling. And then the labor market. We really haven't seen any real material impact on the labor market. In fact, we got jobless claims this week that actually ticked below 200,000. So that's not really showing any signs of weakness yet. And that's really what the Fed is focused on. So we're likely in an environment where growth is going to continue to slow across the economy, seeping into more categories. Earnings are likely to come down a little more, and the Fed's continue their rate hikes for at least probably 2 more meetings, possibly 3. I don't think we're going to get rate cuts as quickly as the market thinks. Powell and the Fed really want to avoid a 1970s type scenario, where in that scenario, the Fed backed off on their restrictive policy and then inflation creeped up. So with that environment, I would anticipate stocks to trend lower in the coming weeks unless earnings hold up better than anticipated. So far, we've gotten about 55 or so S&P 500 companies, and they're beating, but less than the historical average. And I think right now we're on pace for about a 4% decline for the quarter, which was pretty anticipated. But we're still very early on in the earnings season. But with that said, the breadth of this recent rally, which essentially means the broadness of stock appreciation, has been pretty strong. So we might not need to revisit the previous lows. We also have some other dynamics going on, like lower treasury rates, the lower dollar, all good for stocks. But with that said, I do think we'll get more attractive entry levels than where the market is currently priced in. The S&P is currently flirting right around that 3,900 level, a level that I've mentioned many times this year. It's acted as resistance and support more times than I can count. So today we're decisively above that, around 39.30 or so. It's really been carried by Netflix had more subscription growth, so that's getting a big pop. Google's actually getting a pop from their announced job cuts. But it's really going to depend on how the rest of the earnings season plays out. Next week, I think we get 90 companies, including some of the big cap tech. So that could move markets in the short term.
Mike, all right. So, unclear, maybe a little bit more down before we get clarity and decide what our direction is. Is that fair paraphrasing?
Yeah, we still have a decent amount of cash just because the risk reward on the upside isn't there yet. From a valuation standpoint, we really can't see that. We're about 17 times price to earnings right now, looking forward over the next 12 months. Based on the earnings for the next 12 months. So in this environment, you're not likely to get that 17 to move up to, say, 19, or, I mean, we've seen it as high as, 22 in the previous year. And based on where earnings are, you're kind of capped on the upside. But that doesn't mean pretty much in investing, you're just pushing those returns forward. They'll happen at some point.
Right. So I'm going to put you on the spot, and I want everybody to recognize this. This is not our absolute prediction, Mike. I am going to put you on the spot. We're not saying this is going to happen. This is going to be an opinion based on observations, a ton of the research Mike does. Mike, at some point in the relatively near future, let's call it in some point between now and, I'll pick a number, by the end of the first quarter, does the government come out and say we're in a recession or we had been through a recession? Do you think that will happen?
No, definitely not.
Okay. All right. I like it.
But I did hear one of the Fed members acknowledge the decline they're seeing in economic activity, something they've kind of just looked past over the past couple of months. They've really been focusing on solely inflation.
Right. Well, hey, that would be good to hear. I think A lot of folks will say, well, it wasn't great last year. Well, it wasn't great that last year, but that doesn't preclude that we're in a recession or have been through a recession. And also, even if the Fed comes out and says, hey, economy's soft, earnings aren't great, that does not automatically mean the market goes straight to heck. You don't always see a perfect parallel between a recession and the market. Perfect parallel between the economy and the market. The economy could be not great, and the market could start to do its own thing, being a leading indicator of what the market thinks the future could hold. So when we talk about the economy, which is really kind of that discussion about the recession, we talk about the economy and earnings. That doesn't necessarily mean that all of that moves in lockstep. So, Mike, thank you. Obviously, wonderful commentary. Here's what I would like to conclude with. This is what we hear on a regular basis. The market was down, Brian. I don't have time to recover. I just don't have time. I'm older. When I was in my 20s, if the market went straight to heck, I didn't pay attention. I had a lot of time. Now I don't have time to recover. We need to do something. We need to blow up the portfolio, do something completely different. We don't agree with that. Let's look at the facts around that. So what I'm going to reference, I'm going to pull this up on the screen. This is from LPL's research. Of course, LPL is the firm that we have hired to do a lot of the important things that we need to be done. So we have affiliated ourselves with LPL as our broker dealer. They have a wonderful research team. Not quite as good as what we have at HBK. Thank you, Mike. But they are fantastic, and they give us a lot of data. And so what I'm going to show to you is from right along the bottom. You can see the URL this comes from. This is actually from June of 2022. And what it is showing is far left-hand side was the peak of the market when everybody was, hey, I'm fine. You guys don't need to call me. The world is great. The market is going through the roof. The next column going left to right is the month of the low. So the market peaked. Something happened. Market goes down. How long was that period is the third column right there in the middle with the smallest numbers. The percentage of decline is the going left to right is the fourth decline. So there was a peak, market comes down. How long was that? From it was way up to it was way down. How many months was that? And then what percentage? Most importantly, what I'd like to focus on the far right-hand side. How long did it take to get back to those peak levels? Let's go to the most recent one, which is this bottom number right here. So you see those columns. You go right down towards the bottom. March of 2019, February 19th of 2020, February 19th, 2020 to March 23rd of 2020. Laura and Mike, jump in. What was going on from February of 2020 to March of 2020?
Was it COVID?
It was COVID. This was the worst part of COVID. So if you look right along the bottom there, you can see in that time period, that was a 1 month downturn. But
I
in
like
that
that kind of
1 month,
environment better.
What's that?
I like that time frame better.
Yeah, right. Well, exactly. Well, we got some other time frames we're going to focus on. So that was a 1 month time frame. That's the number right here. Market S&P 500, by the way, it's right there down there in those disclosures, goes down 33.9%. It did actually happen that people called us and said, I don't have time to recover. The market went down in 1 month, 33.9%. I don't have time to recover. I'm old. We need to change. Far right-hand side, how long did it take the market to actually recover from that? 5 months. So for those people that called us at the end of March, we're doing, kind of quarterly reviews. Everybody's getting their quarterly statement. Many people called and said, I don't have time. 5 months later, was the recovery from that. That was a really steep and then a really quick recovery. Let's go back. Let's talk about some extreme numbers here. So I'm going to go from March 24th of the year 2000 to October 9th of the year 2002. Laura, Mike, what was going on? 2000, 2001, 2002. Do we remember?
Y2K.
It was Y2K. That was a big one. This was the technology crash, right? Mm-hmm. Remember 97, 98, 99, every neighbor had a mutual fund that was going up 400%. And then the market from 2000 to 2002, which is these numbers right here, For 31 months, the market went down. It went down 49% total in that time period. Now, at the end of 2002, everybody said, well, I don't have time to recover. I'm retired. I don't have time to recover. This was pretty lengthy. We're talking about a little bit more than 4 years of recovery. But did the market recover? It absolutely did. Did the market start to go up significantly after that recovery and beyond? It absolutely did. So for those people, now again, this is the S&P 500. But for those people that stuck to that allocation and said, hey, I'm in the right place at the right time based on my financial plan and my goals, I'm gonna stick it out. It did take a little bit more time for sure, but it was a much steeper and prolonged decline. So though, we're right around in here. The S&P 500 last year was down about 19 and change roughly. Let's look at 2018 from September 20th of 2018 to roughly the end of year 2018. That was 3 months. Market goes down 19. How long did it take to recover? You get to the end of 2018, and I do remember this. The market was terrible. I mean, we just got smoked. In the last quarter of the year, we got crushed. I don't have time to recover. For those people in 2018 that correctly made the observation, the market was terrible in the fourth quarter of 2018. If they had stuck to their allocation, by roughly May, they were back to where they were. That was a fourth. So these numbers right in here are a little bit more in line with what the S&P 500 did last year. You go to 1990. This is a 3-month decline. Market goes down 19.9. You've got a 4-month recovery period. So we certainly understand, both personally and professionally, the emotional reaction to, I don't have as much time. I personally don't have as much time to recover from what the market has been doing most recently as I did when I was 30. Do I have a good financial plan? Do I have clearly established goals with appropriate timeframes? Absolutely. Therefore, that gives me the time and the ability to enjoy whatever recoveries come. We don't know. Maybe, we have an extension of the negative markets from last year into this year. Some of the other data says we might not. Post midterm elections, post a down year, oftentimes the markets do pretty well. But I did want to share the actual data around the emotion of I don't have time to recover, because we think through the planning process and making sure that you have that balance. You have that balance between what your emergency fund is and kind of midterm money and long-term money. If you have that balance, going back to what Laura had talked to, you most likely do have the time to recover. Laura, Mike, any other thoughts, questions?
Yeah, I really like this chart. So I guess from peak to trough on a closing basis, we probably just dip into that negative 25% territory. I think intraday got down to about 27. So what this is telling me is the average decline, or the average tenure of the decline is 14 months. So that would put us at what, March 3rd or so of this year. So we'll see.
Yeah. And then right down here is the summary of all of the observations. And you can see if the S&P 500 in this example is in that kind of downturn period. If it's more negative, then it's 25% or more negative. The average length is 14 months. The average downturn in that is 39, and the average recovery time is 27 months. So it's a little more than 2 years. So if you don't have 2 years for your goal, then that money should be repositioned somewhere. If you do have 2 years throughout your lifetime, throughout your retirement, then there's a good chance you could, historically recover. Now, if the bear market, this line right here, the very last line before you get to the disclosures, is less negative than 25%, so it's 24% or better, if you will, so less negative. On average, the length of that downturn is 7 months, with an average downturn in that period of 20% and an average recovery of 7 months. So yeah, you're Mike, very, very good point. I was kind of speaking in annual numbers. You brought it, our actual experience most recently back to kind of peak to trough. But again, we're hoping certainly that this most recent downturn kind of falls into these trends. And, again, consider your own situation, engage with us on that financial plan and what pots of money are designated for what goals and what timeframes. And then we can have a objective discussion about whether you do or do not actually have time to recover from what happened in 2022. That's what we got. This is Friday Live. So we will be back at it. Next Friday brings us to the 27th of January. Oh, my goodness. It'll be the last Friday of January already, 2023. So thank you for joining us. Again, if you heard anything here that is helpful, throw us a like, throw us some comments. And
Give me a heart.
I'll take a little thumbs up. That's thumbs up, whatever's good.
Give Mike
All right,
the crying face. The crying face on Facebook.
Well, that's only for last year. Hey, we stay positive on these things. Mike, hey, we know, and everybody has discovered watching Friday Live, Mike is a by the number guy. You don't have to, you don't have to laugh about it or cry about it. It is what it is, and you deal with it, and you deal with it the best you can. You move forward. Is that a fair assessment, Mike?
Yep, absolutely. You can't control what's happening. All you can control is your actions in it.
Fantastic. All right. Hey, thanks, everybody. Please join us next Friday, the 27th, 12:30 p.m. Eastern Standard Time on Friday Live. Have a wonderful weekend, everybody. Be safe. Be balanced.